Tell me, which is a better company, A or B? Now you might say insufficient information. So let me give you some more data. Would you like to know what is the profit made by them? Let's say company A has made a profit of 40 million, company B has made a profit of 15 million. So which is a better company? The one that earns 40 million or 15 million? Folks, if you look at absolute numbers, one might get influenced by bigger numbers. The mind tends to be biased in favor of bigger numbers. But the moment you express this as a ratio of profit to sales, we realize in the case of A, the ratio of profit to sales is 20%. In the case of B, it is 30%. So now suddenly we realize B seems to be more profitable than A. I can give you another example on similar lines. Some years back, the GDP of China was about $1.3 trillion. And the GDP of Belgium was $250 billion. Looking at these standalone numbers, one would be impressed much more with China's economy as compared to Belgium's. But now if I give you the population data, at that time, China had a population of 1.3 billion people, whereas Belgium's population was 10 million. If you now look at the ratio of GDP to population, in the case of China, it was 1,000, and in the case of Belgium, it was 25,000. When expressed as a ratio, one realizes that the per capita GDP of Belgium is 25 times bigger than China's. If your intention is to find out how profitable an organization is, then the set of ratios that we will work out are those which fall into a category called profitability ratios. Other times the intention is to find out how stable an organization is. Then those set of ratios are called financial ratios or stability ratios. And at other times one would like to find out how efficient an organization is. Those ratios are efficiency ratios, they're also called turnover ratios, they're also called velocity ratios or activity ratios. And of course, if you want to get an overall picture about an organization, you must do all the three kinds. Current year, your sales is 120 and your gross profit is 30. Let's imagine next year your sales improves to 240. What should happen to gross profit? Should it become 60 or less or more? Answer is it should become at least 60. Gross profit is sales minus cost of sales. If sales will double, cost of sales will also double and gross profit will also double. What if you find sales has doubled from 120 to 240, but gross profit of 30 has not become 60, it has either become, let's say, 58 or it has become 62. Let's imagine it has become 58. How would you react? Is there reason to worry? How much has gross profit reduced by? Marginally. Is there reason to worry? Folks, I think you should lose your sleep. Just because your income has gone up, your rent did not go up, your salary of your administrative staff did not go up, therefore profit went up more than proportionately. Don't take credit for efficiency. In fact, if one knew how to work out the leverage multiple, which also I have explained earlier, and if your leverage multiple in this case happened to be 3, then a reader would have known that if sales has gone up 100%, the net profit should go up by 3 times of 100%, which is 300%. So old net profit is 6, 3 times of 6 is 18, so the new profit should have been 6 plus 18, 24. Maybe somebody needs to be hauled up. Why has the profit gone up only to 18? Folks, what I'm trying to tell you is it is so important for you to know what to get impressed by and what not to get impressed by. I am trying to tell you a marginal improvement in gross profit is a major achievement. And a substantial jump in the net profit ratio may not be anything to write home about. How many of you prepare funds flow statements as a regular practice? I'm sure you make balance sheets and profit and loss accounts and even cash flow statements, but I'm not sure that all of you make fund flow statements. If you do not, I would strongly urge you to begin doing so. Are you trying to say that the loss-making company has millions in the bank because it is making losses? And then I have to tell you, no, I am saying a loss-making company is making losses because it has millions in the bank. And folks, if the profit-making company starts hoarding money in the bank, it is a matter of time before they're going to stop making profits. Or I'm trying to tell you, in my opinion, characteristic of successful companies is shortage of money. I am not saying every company short of money is successful. I am saying successful organizations will be short of money. I have always felt the job of a funds flow statement is less to supply the answers and more to help you frame the right questions to which you should go looking for answers, and based on the quality of answers, you should reach a conclusion. So right now, a question is being framed in my mind. I like this organization. It is making profits. It is efficient. Its working capital has gone down. Despite that, sales has not gone down. It is planning an expansion. It is meeting all its obligations, and it is handsomely rewarding the shareholders. But I'm worried. Why is the sales not going up? Before I make up my mind whether to invest or not to invest, I would like to meet some functionary from this organization, preferably the managing director or the CEO, and I have a question. I'm a potential investor. I like your organization, but I'm worried. Why is your sales not rising? Unless you can give me a satisfactory answer why I must not worry about that, I may not invest. And while I'm talking to the CEO, I have another question. On the one hand, your sales is not going up. On the other hand, your funds flow statement shows a massive investment in plant. I mean, I can understand if year after year your sales was rising and now you're gearing up for more sales. But your sales is already constant. So can you please justify why did you make such a large investment in plant?